Hello everyone, in this video we're going to be speaking about when can you pay yourself a dividend. This was specifically requested and so we'll go through what's needed. First we'll look at the profit and loss, the balance sheet, and we'll be discussing these in relation to, again, what's needed. We're also going to be looking at the tax consequences of receiving a franked dividend. So first, when you look at the profit and loss statement, say we've got income of 500, expenses of 400, so the profit before tax is 100. Tax is being paid at 25%, which means we're going to be paying tax of $25. The remaining amount is $75. Now, we declare a dividend of $75. So really, we're left over with nothing, nil. Okay, let's look at how this $75 is going to be taxed for someone who has a tax rate of 30% and someone who has an effective tax rate of 10%. So the person who has an effective tax rate of 30%, they'll get the $75, which is the dividend. The dividend will be grossed up by the franking credit, which is $25. So they'll be taxed on 100. Tax at 30% is $30, and they get the benefit of that franking credit, the $25 here, as a prepayment on the profit that they've received. So the difference that they have to pay is $5, being the $30 they're required to pay, that's the tax that they need to pay, less the $25 of franking credit, leaves the net amount they actually need to pay. Then we'll switch to the taxpayer who has only 10% tax rate that they need to pay. And again, we're talking about the effective tax rate here. So the same, so we have the $75, which is dividend. Then we have $25, the grossing up, being the franking credit, being taxed on 100. Taxed at 10%, which means their tax payable is $10, but they receive again the benefit of the franking credit, which is 25. So really, they receive a $15 refund. Again, receiving that benefit of the franking credit that's already come across with the fully franked dividend. Now, what's required to actually pay this dividend? Well, you've got to have profits. And when we talk about profits, we're talking about retained earnings coming from previous years, right? So retained earnings or current year earnings, the amalgamation of those two together, okay? So you've got to have profits. Secondly, you've got to ensure that your assets are greater than your liabilities even after you've paid the dividend. This is because you don't want to prejudice against creditors, which means you don't pay yourself a dividend and there be no money to pay the creditors out. That's to a large degree insolvent trading. Again, we're going back to the Corporations Act. Okay, something we've always got to keep in mind. The next one is you must ensure that you're not being prejudiced towards shareholders, which means if you have different classes of shares, so you have share class A and share class B, you can't say, oh, I'm going to pay share class A all of the dividends and not pay class B any dividends whatsoever. So you've got to make sure that you're not prejudicing one class over the other. Okay? Now, when it comes to paying out dividends, this is up to the directors. So the directors can say, you know what? We have profits this year. We're not going to pay out anything at all. Or they can say, we're going to reinvest the profits. Or they can say, we're going to pay out the profits. They can also do a mix of all of those three, right? So it just depends where the company is at, what the shareholders want, and the vision the directors also have. Now, if you're not happy with the directors not paying out a dividend, what you can do is you can vote for the directors that will actually be paying out a dividend. But ultimately, you've got to keep in mind where you want the company to get to. And also remember that when you pay out a dividend, this is actually a cash transfer. So cash is being transferred out of the company to the shareholders' accounts, which means there's less money there to be reinvested. In the long term, that might not be very beneficial for the entity. It just depends on what the stakeholders want. Ultimately, the company is there, it's being operated for the benefit of the shareholders. Now, who are the organizations, bodies that regulate this space? Well, predominantly it's the Australian Securities and Investments Commission and the Australian Taxation Office in terms of the taxation, which obviously plays a role in these calculations. What we need to keep in mind is tax law and the Corporations Act as part of some of the other legislation we need to look at when we're running a business. Now, in terms of assets, liabilities, revenue, expense recognition, really we need to be looking at the International Financial Regulations, the IFRS, and the Accounting Standards Board for the accounting standards for those recognitions. So you can see there's various aspects here. Now, in terms of retained earnings, we're looking at retained earnings from an accounting perspective, not from a tax perspective. Okay, so for example, for tax purposes, you can have a loss, but from accounting perspective, you can have a profit. And vice versa. From a tax perspective, you can have a profit, but from an accounting perspective, you might have a loss. So to pay dividends, we're looking at the accounting perspective. Keeping in mind that we've got to juggle all these other various areas to ensure we're doing the right thing and we're issuing dividends out according to the Constitution, according to the Corporations Law, and again, not being prejudiced towards creditors or shareholders. I hope this video was of benefit to you. Like, subscribe, so you can be notified of when we post new content. Let us know what feedback you have in the comments section. Would absolutely love to hear it. Thank you for your time.